All right, I'm going to start here really quick. I see more people coming in as we start, but I'm going to go ahead and begin. So today I'm going to kind of go over, I think it's actually 11 chart patterns. I know I wrote 10 earlier. That are pretty significant for any kind of trader, whether you're a day trader, swing trader, even if you're not really a trader, you're more of an investor to kind of, annotate certain trends. So these chart patterns are going to kind of help you establish and give you an edge as you're trading, right? If you're not familiar with any of these chart patterns. So pretty much why use a chart pattern? Okay, first and foremost, chart patterns kind of show you a continuation signal that a certain trend could continue, right? In its given momentum, in its given direction. Let's just say it's going up, or if a certain trend is, you know, making lower lows, right? And it's continuing to show weak signs. This is a strong, signal that everyone can kind of dictate. If you see higher lows or lower lows or whatever it is, that that's the certain trend in a larger time frame, right? Um, and other chart patterns, right, which we're going to go over, right, could also show you a potential reversal, right, in the chart pattern. So something like, head and shoulders, right, which is infamous with everybody knowing when you see peaks, right, you see the middle peak at the highest point and you see a break of the neckline, and you were going to go over this. But these chart patterns will kind of help you as a trader or an investor to determine or dictate this change of direction or the momentum going forward, up or going down. um Regardless of these chart patterns, though, you got to understand that all of these chart patterns are not 100%. They are going to make you rich overnight. They're not going to provide you 100% guarantee that it's going to move in your favor, but it does help you have that extra edge. Let's just say maybe like a 65-35, right? If you understand these chart patterns and you understand, let's just say a bull flag, right? Nice long candle up, a nice little consolidation down, and then an edge up, forward up, right? You have the higher probability from this move that this will be the direction that it will, you know, happen in the future. Okay. Of course, this doesn't necessarily have to happen, right? That's why the move is not 100%, all these chart patterns, but you have that higher probability. So given what when I say, you still need to manage your position sizing and risk tolerance, just because you see a bull flag forming does not mean this trade is 100%. So it does not mean you should dump your whole portfolio on this trade, right? You still got to manage how much you're willing to risk to take on this trade, as well as if you do enter on this break, right? Where are you going to place as your stop loss if this whole scenario doesn't, go in your favor, right? If it just fakes you out and it dumps back out, where are you going to exit? This is where it comes into the play. Okay, so that's just first and foremost before I get into these chart patterns. Um, So the first one is head and shoulders. Everybody should know this chart pattern. It is kind of not, I guess you say, easy to pinpoint for newer traders to see. Of course, this being the shoulder, this being the head, and this being the shoulder. When you guys see these kind of formations, especially on a larger time frame, right? Anywhere from a daily chart, right? 1 year, 1 day, right? To even weekly charts, right? Or even monthly, if you want to go stretched out that far for investors. These are good patterns to kind of indicate a certain reversal in a trend. Okay. So pretty much, like I said, the left shoulder, right? The head, which is the middle peak, which is at its highest price point, and then the right shoulder. Okay. When you're looking at this in hindsight, right, you're just seeing, oh wow, obviously that's head and shoulders. I mean, you see this obvious lower left shoulder, middle highest head, and then you see the lower right shoulder, and then you see a break of the neckline, right? This is what's called a neckline, also known as a level of support. Okay, this is going to be something critical for you to understand of where you should kind of get into the trade, or where you should kind of, if you get into this trade prematurely, where should you get out in a sense. Okay, so a lot of people who have trouble, or a lot of people who can actually, you know, pinpoint this chart pattern, they have trouble executing this trade. Okay, what I found that is most helpful for me when I'm trading a chart pattern like this is that where my entry would be, right? By textbook play, your entry should be below the neckline. Okay, if you saw this left shoulder forming and you saw this middle head, and then you saw this peak of the right shoulder, okay, honestly, how I would trade this if I saw this next candlestick right here on the red is I would enter actually prematurely somewhere after seeing this. Okay, and my price target after entering here would actually be the actual neckline. Okay, this is where higher level traders are making trades like this prematurely because they see this right shoulder, forming before this whole chart pattern actually plays out, right? So the fact that they think, okay, a head and shoulder is probably going to form before it actually formed, I can enter here prematurely. My conservative exit would have been that neckline. And if I wanted to get into aggressive exit, right, meaning a higher profit margin, right, then I would exit actually when this breaks the neckline and it hits the height of the head, okay? The height of the head for maximum risk to reward, right? Okay. However, if I were to enter here, right when I saw that peak of the right shoulder, what my stop loss would have been at this given point would have been that top of the right shoulder, right? Because when you're basing this trade off and you're looking at this exact chart pattern, you're already thinking, I'm trading this based off the head and shoulder. Okay. And that's it, right? And if this is not forming that right shoulder that I, predicted that it would, and this was a fake out red candle and this just popped higher and made higher highs, obviously this is not that right shoulder that I was imagining. So I should be able to get out that trade. However, this trade actually went in that favor, right? And it went to that head and shoulder. So this would have been a massive profit right over here. However, if you wanted to do it by textbook, right? You saw this shoulder, you saw this head, you saw this other shoulder, and you're waiting for that break of the neckline. And this would be your entry, right? There's two factors. There's two ways you can trade this. One, the textbook setup where if any resistance or any support breaks, you want to wait for that retest, and that pullback would be your entry, right? So if this broke right here and there's another nice green candle, that would have been your entry to play on the downside, and your stop loss would have been right above the neckline. Okay, anywhere above the neckline, wherever you feel comfortable risking to take on this particular trade, right? Of course, there's other traders as well that just get in immediately from this neckline because they think this is a high, a high price point where buyers are pushing this up. So they're expecting if this breaks, buyers aren't going to be here anymore. It's just going to be immediate downfall selling, which it can happen, right? I mean, we saw this many, many times. There is no exact play of how the market gives it to us. That would, if there were, we would all be rich, right? But sometimes market could fake us out, right? It could go back up. It could just immediately just dump. It doesn't even give us any room for entry. It just dumps. Imagine this one big red candle just dumps, and then we don't really get a nice entry point, and now we're just chasing this huge move of where that profit target should have been already. So how you base this trade off, right? If you do enter at the neckline break immediately, I would honestly use the neckline as a level of stop loss just because it might just be a fake out. And if you're trading options, your implied ability which is something that's known as IV crush, would pretty much just deteriorate all of your profits. Okay, you're probably even going to be losing money if it goes back to that price point just because of that huge drop in a short amount of time. Hold on, give me 1 second. Does the head and shoulder pattern follow the same rule if it's on an ascending trend line? Yes, it does. So the head and shoulder pretty much is a chart pattern that is known for an actual reversal. Okay, if let's just say, I wish I had an actual chart to show, but let's just say we were making higher highs, right, and it's obvious uptrend. I mean, obviously you wouldn't see this head and shoulder form unless you just see it drop, make a little bounce, and then let's just say you're at this point right here before you see that actual maybe see if we make it clearer. Hold on. That makes a little sense, right? So this is the left shoulder. This is the right shoulder. Oh, sorry, this is the head. And then you're assuming this is going to be the right shoulder right at this point. Okay. Of course, you know, an aggressive trader, like my first example, would to enter if this next red candle popped here and you're saying, okay, this is going to be head and shoulder as a matter of trend reversal from that uptrend. Okay. As a more conservative trader, is you're just waiting for this to confirm, falling back down to the actual neckline, all right, which is this line right here. Okay. If it breaks this neckline, obviously, then perhaps we can actually see and confirm that this is a strong chart pattern that is going to kind of dictate the prediction, which is this. Okay. So that's just the move of certain ideas on how you can trade head and shoulders. Most of the time, you know, people that see head and shoulders, they try to catch that huge reversal. You know, if you're not really a reversal trader, you're just more of a trend trader. Ideally, if you saw this head and shoulders, you necessarily won't take this trade on, but the sizing and the position that you were in the trade going up, you probably might want to scale out of when you see something like this start to form, just because you're like, okay, an imminent sell-off, an imminent breakdown it may happen, right? You now at this point, you're just managing your risk. Okay. You're managing your risk. Okay. Of course, like I said, market is never 100% by textbook. I mean, anything could happen from this given point at this neckline. It could dump, it could retrace and then give us a nice entry and then dump. It could fake us out and then make higher highs. It could not even break down from this red candle as we projected from the initial first aggressive entry, and it could just pop back up. Or from this initial entry, it just dumps from here. Doesn't even give us a period of consolidation. Just completely dumps. So there's many scenarios, but at the end of the day, however entry or exit that you put on, the main focus is that you have a level of stop loss, you have a level of entry and exit. At the same time, you have a level of price target and profit taking. Okay. All of these factors, you know, compile into a nice trade for risk to reward, because if you have all of these entries and exits, right, of where you're predicting the price is going to be, and you're maximizing your RR, right? I mean, regardless if the trade went against your favor, at least you had a nice game plan to execute it, because if it went in your favor, I mean, Jesus Christ, that would have been a very nice trade on your end. This is something you could probably show off too, seeing you saw this prematurely. You know, you had a strong conviction. You know, you maybe if you want to, you know, dive into a little bit fundamental analysis and whatnot, and you said, okay, you know, XYZ catalyst is happening. This happened. Jump in case of coronavirus, whatever it is that bring the stocks down, and then you just said I had a high conviction at this point, and then you shorted, you bought puts, whatever it was, and it just dumped. I mean, that's a trade that I show off. You know, that's phenomenal. But I mean, anyways, going forward to the next chart pattern is obviously good there. Inverse head and shoulders, right? So pretty much the exact same methodology as a head and shoulder, except we're in a downward trend. Okay. And we're trying to catch that reversal to the upside. Okay. A head and shoulder, what I explained earlier, was a reversal to the downside, as in there was an uptrend and we're trying to catch that reversal to the downside. Okay. But in the inverse head and shoulder, pretty much it's the exact same concept. All right. You have your left shoulder, you have your head, you have your right shoulder, and you have that neckline, right? In this case, our neckline would be a level of resistance, all right, not support. So we want to see that break, all right? If you see this break, we can have a stronger confirmation that this chart pattern is signaling us that this is going to be a reversal to the upside. So buying calls, buying equity here, whatever you think it was or it is for XYZ stock, would be a nice price point to enter. All right. Like I said, with head and shoulders, inverse head and shoulders, same thing. If you enter here prematurely, you have to understand that this right shoulder, in this case, right, would be a level of your stop loss if you entered here, right? If you entered really prematurely, or if you entered at the neckline, right? Have it at that candle or whatnot, 1 to 2% below that neckline as your stop loss. And again, profit target, right? A conservative profit target, a nice profit target by textbook is the height from the head and shoulders. Okay. Of course, if you're basing this trade off, and let's just say, let me make it a little bit more cleaner. Okay, L H R. Okay, let's just say you bought here. This is your price target, the height, and it hits right over here. And what it does is it continues the trend in your favor. So meaning your head and shoulders is pretty much confirming that this is what you called out and what you saw happening prior to the actual, price action of what it showed us. And if it broke this price target of yours and you did not exit your trade, you didn't scale out of the trade, you didn't even sell one contract or whatever it was, you just completely, being greedy here because you think it's just going to go blast off to the moon for some reason, and it continues, dumps off, you should be able to, or you should actually kind of, I don't know, smack yourself on the wrist and whatnot for not taking some profits here at that price target. If you're trading, or if you're making a trade based off a certain chart pattern, in this case the inverse head and shoulders, and you're not taking profits based off this chart pattern, you're literally just saying, okay, I see inverse head and shoulders, it's going to have a reversal here and it's just going to continue up higher, but you don't have an exit. I mean, then that's yeah, you really need to slap yourself on the wrist. If you're trading something that's head and shoulders, you should be able to get out based off the trade of head and shoulders. Doesn't matter if the trade kind of blasts off to the moon afterwards. Yes, everyone would say, oh, I should have held, I should have done this, I could have, should have, would have. Doesn't matter. Based off this exact trade and what you saw, this should have been at least a price point of where you should scale out of a trade, meaning managing your risk, right? If you had 10 contracts, maybe take out 5 contracts, right? And if this was a 100% return, you're just playing with house money at that case, right? So something like that is a strong, I guess you could say, reason that people that trade these reversal chart patterns have trouble taking exits and taking profits of, because they can see these chart patterns from a mile away, right? Maybe even at the head, when they saw this head forming with this long upper wick, and then they said, oh man, this might be a head and shoulders, right? We fall back down to the neckline and we bounce back up, right? I mean, if they were to dictate that at that moment, they should be able to say, okay, this is going to be my price target. If this shoulder forms, if this neckline breaks, I'm going to take profits right over here. Okay, so that's just, it is what it is, right? And if you don't, right, there are some scenarios where if you don't collect any profits, and let's just say it just blasts off and it goes up to, like, I don't know, 3 times. So your reward to risk is like 3 to 1 now. You're just risking like this to get 3. I mean, in that case, then that was a phenomenal trade. That was the best trade you can probably take. Of course, the market isn't so nice and willing to give you something like this every single time. So just because you make one trade, and let's just say this made you 3 to 1, does not mean the next head and shoulders that you call out is going to give you this exact reward. Okay, guys. So that's just one thing that I wanted to make clear. But damn, if you made 3 to 1, that's a pretty good trade. But anyways, next chart pattern, the double top formation, right? Just like a head and shoulders, it's also used for a reversal indication. So something like this, in most cases, is actually more easy to locate, but a little bit harder to execute, in my opinion, because when you see something like this, doesn't matter if it's a larger time frame or shorter time frame, it's hard to dictate, because a lot of times when someone says this is the neckline and this is a level of, in this case, a level of support, right? What most scenarios could happen is that from this neckline, from this support, it just bounced back up, right? And some would say this could be another, triple top, right? But a lot of times it could continue to consolidate like this. So anytime I see a double top, I take it with a grain of salt. Okay. This is one of the chart patterns that I rarely trade. I would trade if I would only trade this if I saw massive volume, okay, on both ends of this of the selling, okay, from this price point right over here. Okay, that's the only idea I would take on this trade. If I see the same level of, like, volume throughout all of this, and then obviously we sold off at this price point and at this price point, I would take this pattern with a grain of salt. That's just how I would trade it. But of course, there's with any chart pattern, with any trader, with any strategy out there, there's any kind of small price action could actually, determine if this trade is tradable or not. But of course, just by textbook basis, double top formation, see these double tops, a nice little wick, nice little upper wick, right? Shows that sellers are actually coming in to push this candlestick down, and then a break from the neckline. Same exact scenario. Take on the entry here if you want to go conservative, if you want to wait for the pullback. Maybe sometimes the market is willing to give you that, or if you want to go a little prematurely, right? Whichever, or you use around this area 1 to 2% as your stop loss. And the price target, of course, would this be, it may just be the height of the double top, but most cases when you see a double top, it's not necessarily a double top. It's just going to be a break of support and a breakdown. And when you see that breakdown, it might, if you're day trading, right, for what I'm taking, out of my experience, is that this is probably going to be around pre-market low, pre-market high, breakdown. I'll take profits here, not necessarily the height at this point. And going on to the next chart pattern, double bottom, same exact scenario as a double top, but in this case, we are catching the bottom, not the top. So at these long lower wicks this time, lower wicks, right? That means buyers are coming here to push this stock up, meaning they want it at this certain price point, right? This could be $20, this could be $30, whatever it is. Let's just say it's $20, meaning a lot of people like this XYZ stock at $20 and they're willing to pay at $20. And a break of this neckline is going to give you that confirmation here, right? So another means of confirmation here too is if you want to get in prematurely, which, I mean, as a day trader, you kind of have to realize these patterns before they happen because you're late to the game. If you notice it way too late, you're already going to miss, like, especially as a day trader, like I said, you're already going to miss this whole move, right? But if you were able to catch this prematurely, and let's just say you saw this bottom form, you saw a lot of buyers push in with high volume, and then you saw it kind of fall back down to this price point, and now you're watching this on a 1 minute time frame chart, and you see another large volume bar come in, right? Then you're just kind of like, okay, I feel comfortable maybe taking this trade on. Maybe I'll enter at the next 1 minute candle, but I'll use this break as my stop loss, okay? Because perhaps this is showing me a double bottom, right? Based off the volume indication, based off the $20 price point of what buyers are kind of pushing this up. And the second confirmation, if you were to get in prematurely, is if we're making higher lows, higher lows, higher lows. Okay, this was a downward trend, obviously, right? From a double bottom. And then we're trying to catch that reversal. Okay, now from making lower lows, we want to see it make it higher lows. Does that make sense? To catch this double bottom. Okay, exact same idea. All right. So if you got in prematurely, use this as a level of stop loss. Use even 1%, or just because market makers will sometimes like to trigger you out and execute your trade. If this is your stop loss, they'll try to capture your gains, maybe do a triple bottom and then continue in your favor. But maybe like 1%, I would always risk a little bit more just because I want to take on the trade based off your conviction. But if you made that trade and you saw that trade making higher lows, higher lows, higher lows, oh, excuse me, then that's a good, a strong kind of confidence for you, a confidence booster that you can see that this is a strong double bottom reversal pattern. But other than that, I mean, these are very textbook plays, right? Try and study these chart patterns. I mean, these chart patterns, if you can kind of predict them before they happen, it is very rewarding. It's going to kind of hinder yourself as a trader to the plus side. But anyways, going on to the next is cup and handle. Okay, we're getting a little bit more and more, I guess you could say, advanced of how you can kind of viewpoint these chart patterns ahead of time. So a lot of the times people get confused with a cup and handle first, is they think that this is going to be a double top. Imagine we don't see any of this yet. Okay, guys, cross all this crap out. Imagine we don't see this yet, and we see that red candle. A lot of times, this is why I don't like to trade double tops, is because you can get faked out here, right? Cup and handle is a bullish conviction, continuation pattern. I like to trade this, especially on a daily time frame. It's very, very rewarding. especially when you already see the handle begin to form, because this is in general is a bullish continuation pattern, right? From this break of so-called cup, right? Or if you say so-called handle, this should continue higher. And the same exact price target as what we talked about with head and shoulders is the height of this. That would be your price target. But the reason why you know, this is kind of a little bit more advanced for traders is that when they see this pattern before it in hindsight, right? If before it forms, they see a double top first. Okay. However, they miss this whole idea that the cup was forming. Okay. When you see price action form like this, which is also known as a rounding bottom, which I don't think I added to my slides. I should have. But anyways, that's another chart pattern that's a little bit more advanced. This is something where you don't see a nice consolidation, right, sideways that we like to see, in just regular, textbook plays and whatnot. This is something where you see small market makers kind of trick you on thinking that sellers are actually pushing this in, where an idea it's actually buyers just trying to push it back up. Okay, it's just as simple as that. Don't have to make it too complicated. But when you see this, a lot of times people like to think it's a double bottom. Oh, it's all right, double top. So they plan to short here. I mean, ideally, if you saw this before it happened and you shorted here, it's not a bad move, right? And then you're trying to gain for, let's just say, or I guess 3-1 again. All right, and you want to capture this move to the downside. Maybe back if you're a range trader, you want to capture if you're a range trader, right? And then you saw this move, right? Exactly what you see. And then you want to capture this price target from here, entering here. I mean, that's not a bad risk to reward trade, right? You enter here, you see this nice red candle too, and you're expecting this to dump. However, you just got, I wouldn't say faked out, but you didn't see the next chart pattern of this, cup and handle forming, right? Then that's something where it's like, okay, regardless of what it was, if you held on to this trade and you didn't take this small little profit, and maybe you had your stop loss here and you broke even, whatever it was, I mean, that trade still wasn't bad on your end, even though you didn't make any money, but it just kind of shows you that, oh, you missed out on another chart pattern, which obviously was the correct chart pattern to trade off of. Okay. Of course, it goes and boils down to just risk and reward, because if this was a double top, this would have rewarded you very nicely. However, in this case, it wasn't. It was a cup and handle. So anyways, going back to cup and handle though. So this is, let's just say, well, the neckline resistance, the top of the cup. A lot of people that like to trade this is when they see this move right here on a bigger time frame, they see the cup and the handle, right? If they see this and broke it down to, let's just mark this, and they don't see this anymore, a lot of people would say this is a bull flag. Okay, regardless of what it was and what it is, if you see a bull flag here forming before the cup and handle, okay, and then after that you go back and zoom back out into historical price action, and then you see that cup and handle, that is two confirmations that this thing is going to blast off higher in your favor. So basing off of this actual chart pattern, this is probably going to give you like a 75% probability to the upside already. Okay, if you didn't see this whole cup and handle, you saw this bull flag first, and you're thinking, okay, I'm going to get in on that break of that flag, and it doesn't. Let's just say you thought of it like right over here. Okay, it's like, oh man, that's a bull flag, no doubt, and you just have to wait for that consolidation period to end, right? And then let's just say as this consolidation period is happening, you're zooming back out and you're saying, oh crap, now I see this whole cup and handle. Like, I'm definitely going to take on this trade. Okay, that's two levels of confirmation that has to go upside, right? But of course, all boils down to risk management as well, and your entries and exits. Of course, when you're trading a cup and handle, you want to enter at the break of the handle, not anywhere before. You can't really enter prematurely here because a cup and handle can actually consolidate quite a bit, okay, before it actually blasts off. All right, guys. That's just to keep in mind. You want to make sure that this level of resistance here would be your level of entry, and of course, a level of exit if you want to risk a little bit more to play on this trade could be the bottom of the flag, bottom of the handle, whatever it is. Or if you don't want to risk as much, top of the 1% down, or top of the next, or sorry, the bottom of the previous candle. Again, it boils down to how much you want to manage, how much you want to risk on the table to take on this trade. But if you were to get on this trade to the upside and you got it correct, This one is the big textbook play with the height. Height should be your profit target, okay? The height of this should be the profit target of where you should start scaling out or get out of it completely, whatever it is. That's the exact same textbook trade that you should take when you're trading the cup and handle. On to the next one, wedges. Okay, so wedges, right, is a little bit, we're getting a little bit more and more advanced. For you advanced traders out there, I mean, it might not be that advanced, but I mean, it might be a good refresher. So right now I only have the rising wedge formation and pattern showing. But something that you need to keep in mind of is that usually when you see a rising wedge for the beginner traders out there, it pretty much dictates that, let's just say, or so usually when you see a rising wedge, okay, it kind of tricks you for the newer traders, because ideally when you're learned and you're taught all this bull flag, cup and handle, yada yada, when it's kind of going up in momentum, it should continue up. Well, in wedges, it's a little different, because in most cases when you see this wedge going up and higher, at the apex is usually when it breaks down and it goes the opposite of the direction. Okay, if you see a falling wedge, right? So it's just pretty much making this. Crap's the ugly picture. But anyways, it's like this. Okay, and it's falling down, right? Usually it goes to the upside at the apex, at the break, okay? At where it squeezes to the finest point, that's usually where it breaks. But anyways, I'm just gonna go over rising wedge that's shown right here. So the only way you can actually trade this too, in my opinion, I would always wait for confirmation in this particular chart pattern if you were to trade it, just because even at that apex, when you have a slightly higher probability that if it's a rising wedge, it would break down, and if it's a falling wedge, that it would bounce up, you want to make sure you have that confirmation, because usually when a price point squeezes this hard, okay, the massiveness of the candle that pushes in either direction is going to be big. And if you catch the wrong side of this trade because you entered prematurely, I would guarantee you that you would probably just throw out your whole game plan, because you don't really have a stop loss. Because that next candle at that squeeze of the apex is going to be maybe 1, 2, 3%, 4% down, or 1, 2, 3, 4, 5% up. It's going to be so large that you're just immediately going to lose, or you're immediately going to win. Okay. So always wait for that confirmation. With wedges, what I like to do is I don't really necessarily like to wait for a pullback. I always trade on pullbacks, just because, like I keep saying, every week after week, month after month, it's a little counterintuitive, but you always want to enter in the direction on the pullback. So if you're entering going down, you want to enter on a pullback with a green candle. If you're entering going up, you want to enter on a red candle. Okay, that's just how I want to trade, right? But for this particular case, for wedges, I always enter on the break. If this was a strong red candle on the break, I'd get in some puts. I'd short this as quickly as possible, right? This is where active trader comes in very handy. I don't buy market. I don't sell market. I usually buy the ask or sell the bid. So in this point, I buy the ask right now. Whatever it is, ask me. Let me buy it. Let me short it. Let me capture some games here, a scalp, a day trade, whatever it is. But yeah, as long as I have that confirmation for the break, is how I would trade this. I don't have to wait for the retest, because when a wedges don't really retest here, they if they're gonna break off the apex, trust me, they're gonna break. You can watch it, and see from different patterns. I mean, they don't form too commonly, but when they do, you'll notice it. And going on to the next pattern, so pennant or flags. So this particular one is popular, very easy to pinpoint as well. The main, I guess, difference is for pennants, right? It's a nice sideways movement, and it's really large, right? For wedges, it was very, very slim. Okay. That's the main difference. Exact same way how you would trade this at the break of the apex, right? But for this particular chart pattern, I like to wait for retests. I like to wait for pullbacks. As you can see here from this, perfect example actually for me. I didn't even notice, but you can see that let's just say this right here is our level of support right after it breaks. And you can see that if this was the 1 minute time frame, whatever it is, right, you can see it broke out, right, giving us a little bit higher probability that we're going to trade this to the upside based off, this pennant formation to the upside. However, it does retest, right, in the future. Okay. Even though it retests on the next candle, maybe I would have entered here. Okay. And if I were to enter here and I used, let's just say, the break below, right, as my stop loss, and I see this nice red candle here forming, this would have been my second entry. Okay, I would have scaled in more into this position if I saw this here, just as long as it doesn't hit my stop loss. However, right, I mean, if I were to enter here more, right, since my initial position here and in my second entry here, right, that means I'm putting more risk on the table on the trade. I'm risking more to make more. All right. But of course, I'm also risking more if it does not go in my favor, that I would maybe lose a little bit, right, based on my stop loss more than what I would initially if I didn't enter more. However, for this particular trade, if you saw a bull flag, pennant flag, whatever it is forming, and you saw this pullback and not break below your stop loss, this particular scenario would have been a nice second entry point. You could probably scale in more. Let's just say you bought like 5 contracts here and you saw this and you're like, let me buy like 2 more contracts here. Okay, something like that, right? So that you're risking a little bit more to gain more profits because you're thinking that this trade is still intact. It's not going anywhere, right? I mean, there's no reason for you to get faked out yet either, just because you saw this, unless you're thinking, okay, I entered here, I made this much profit, and then now you have your psychological, mindset getting fucked up because you're like, okay, I made this much profit. Damn, I just lost it all on that next candle. I'm just going to probably exit here. No, that's not how you should trade, right? As from this entry point, you told yourself this was your stop loss. So unless this hits your stop loss, or unless it hits your price target, right, your profit target taking, whatever it is, right, there was no need for you to exit the trade yet, unless you really had some other indications, right? You're watching SPY, right? In this case, we're getting a little bit more advanced. You're watching, other charts, and you're just saying, okay, you're listening to the news, right? Something that kind of influences you that, okay, wow, this red candle is very alarming. I think we might actually break down. I'm going to get out as soon as possible. Then that you can tell yourself, okay, I'm just going to get out here, right? But if you didn't, and no other indication, but this nice little red candle, I mean, there was no point of you to get out of the trade. Okay. Very clear cut, nothing really into it too much. But of course, like I said, with pennants and wedges and whatnot, a pennant is pretty much a little bit more thicker, right? It's a nice little triangle rather than wedges or nice and long. So same with the pennant. We are talking about ascending triangles now. Just a few more here, guys. And I know it's getting a little bit to the point where it's like repetitive, but ascending triangle, right, is another chart pattern that I love to trade as well. Very easy to pinpoint when you're watching this onto a chart, into your actual platform. Pretty much you have your textbook resistance and you're using the trend line as your support, right? Making higher lows, higher lows, higher lows, higher lows. Okay. Of course, you want to see this. If you're a breakout trader like me, you're not really trading any of this chop yet. Okay. Any of this chop yet, you're not trading. Okay. There are range traders out there that just say, oh, when you see this hit, I'm going to take on the trade and let it hit resistance. And when it hit resistance, I'm going to take on the downside and let it hit support, and this, and then that, and then this. That's just too much for me. Takes too much headspace for someone to do that. I don't know how these range traders do it, but regardless of what it is, I'm a breakout trader. I trade based off what I think and predict is going to happen. I try to capture that speed of it too as an option trader. So I'm waiting for this. I see this strong level of resistance, right? Wicks, and then sellers came in all 4 points, maybe even 5 if you want to consider that. And then you see higher lows making on that trend line, right? At that apex or at that break of the resistance is when I want to enter. Okay. This goes back to the beginning of Head and Shoulders and whatnot. As long as you have a nice game plan of where you want to enter and exit, right? It's fine by me if you want to enter here prematurely. If you saw this higher low 1, higher low 2, higher low 3, and you're just saying, wow, this is already squeezing, I think no doubt this is going to shoot to the upside, right? And then you have like an 85% probability that it will. I'm going to enter at this when it hits this trend line here. So I'm going to capture a little bit more gains right here. I don't have to wait for that breakout, right? Because now I can probably capture a little bit more, right? Maybe make it 2-1, right? Here in this case, okay? So if you were to kind of, continue to study and practice these kind of chart patterns, and you're thinking, oh, wow, this is a ascending triangle, maybe I can enter prematurely, this will reward you in the future, right? If you can see and dictate this before it happens. But anyways, let's just say we entered here and we caught out here. We entered here and then we saw this break of resistance and it continued in our favor, right? At that break, as a day trader, I actually like to capture whatever candle gives me that highest implied volatility move or the speed. So if we broke out very quickly with a strong volume, right? Obviously, I would probably get out very quickly after this break because I'm just taking on that scalp, taking on that day trade. If you guys are on a larger time frame and you saw this forming, let's just say this is a daily chart, which is crazy if this was daily chart because these are all 1 days, right? And then we had this breakout. If this was a daily chart, this would probably blast off maybe like, I don't know, maybe at least 5 to 10%. Usually it's probably with the catalyst, right, with earnings or something for it to happen. But that would be a crazy move. If you had a catalyst going into a chart pattern like this, I don't suggest trading it because it's still a gamble. Anything can happen if you're squeezing it back into this chart pattern, and then you're just waiting on a certain catalyst, a certain news, right? Let's just say earnings, right? Earnings report to happen. I mean, just because it's showing you an ascending triangle doesn't mean it's going to happen up. You might have the higher probability that's going to go up, but if you're banking on a certain catalyst, such as earnings report, for this to bank up, your conviction better be strong based off any fundamentals or news or speculation or something like that, because anything can happen at this point, right? If it squeezes here and you unfortunately have a earnings report come out or something, a catalyst, then basis boils down to risk tolerance, right? How much you want to risk for this trade. If there was no ER, there was no catalyst, and it's just started squeezing like this, like on a I don't know, as your day trader, I'd happily take this onto the upside. Let's see. Let's move on to the next one. Yeah, descending triangle, same exact concept, right? Instead of making higher lows, though, what are we doing? We're making lower highs, following this trend line, and we're using this level of support instead of resistance. Okay, at that break, this is a possible retest for you to add or for you to wait from this break as confirmation, right? And then you take this onto the downside. Okay, simple as that. Bearish continuation. Okay, right over here. And that is all the chart patterns that I have. Can you make these slides available to us? Yes, Angel, I will be posting. Oh, actually, the slides. Yeah, I can actually. That's a good idea. I haven't, so I pretty much have a bunch of crap that I've been wanting to go over. Of course, it's a little bit too much if I go over it all at once in one webinar. But I mean, I could break down these slides. A video is recorded, and I'm going to share this with you guys on YouTube. So if you want to just pause, take a look at them as well, that'll be up to you. But yeah, it's a good idea. I can make these into the actual slides and give them to you. Do you guys have any other questions though? All right. If not, thanks for joining, guys. I hope this session was pretty good, pretty informative. Take care and have a good short week, and happy Thanksgiving. All right, guys, take it easy.